Hello and welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me always, Hormuz Fatakia. And look who's joining us today on Trading Hour. Ritu, she's a name you're all familiar with, but now donning the hat of a market anchor. Ritu, great to have you in the...
It's great to be here. I'm thrilled to be here with the two of you. I've heard the morning team's quite fun, so I'm very excited to join in on all of the action.
And what a day, right? It's a strong start to the month of December. The Nifty is currently hovering at 26,230. So we're up close to about 0.3%. The intraday high today, the all-time high level on the Nifty was about 26,325. The Sensex is also holding up in the green with a gain of about 100 odd points. We've come off from the session highs, but it's a new record nonetheless that markets have hit in early trade. It's a new milestone for the Nifty Bank too, as it topped the 60,000 mark for the first time ever. Broad-based buying seen in banks, autos, financial, that's fueling the rally. And Ritu, I think it's that, I think the momentum was building over the weekend once we got that GDP print of 8.2%.
Absolutely, and nobody would have guessed that 8.2% number. That was positively a stunner and way above what the street was estimating. And you have the economy firing on all cylinders. So you can't really find any fault there with the numbers, the 8.2% kind of a growth that we've seen. But
it just complicates the RBI situation, right?
Oh, very much.
When you've got growth at 8.2%, inflation at record lows. Let's see what the RBI throws up. But let's get it down to stocks.
Yes, and Hormaz is standing by with all that's buzzing in trade. Hormaz?
A little nugget on the Nifty Bank, though, just before we get on to stocks. From the COVID lows, just looking at the Nifty Bank at 60,000, it's up 250% from the lows that it made back in 2020. So that is the kind of moves that you've seen on the banks. And of course, that has had a cascading effect on the Nifty as well. We may be off the highs of the session, but there are plenty of movers in the broader markets as well. Start off with JM Financial today, and it's the top gainer on the Nifty 500, 7% higher on the stock today. Is gained in 4 out of the last 5 sessions. In already the first couple of hours of the trading session, the volumes are the highest in the last 4 months, and over 3 crore shares have been traded already on JM Financial. And take a look at the 20-day average. That's just 20 lakhs. So it's 15 times the 20-day average already in the first couple of hours of the trading session. IEX is making a move on the upside today after ending at the lowest point of the day last Friday. The stock is up 5% and it's gaining on very strong volumes as well. Last week was a bit of a forgettable one for the stock as it had gained only once all through the week. But today's session already 1.2 crore shares traded, 20-day average of close to 24 lakh shares. So that is also 5x of the 20-day average. So moving higher on very, very strong volumes is IEX. And the last one on the list today is Salzer Electronics. That is the top gainer on the small cap index today. 9.5% higher on the stock. They snapped a 2-day losing streak. The stock was up around 13% a couple of weeks earlier on the 13th of November, and the volumes are all set to cross that number already in the first 2 hours of the trading session. We have had 13.5 lakh shares being traded on the stock in this 9.5% up move. The 20-day average here is only 50,000 shares. So broader market names, although the indices are off the highs, there are stocks that are moving and are moving on very, very strong volumes as well.
All right, Hormaz, thanks very much for taking us through that. But the big story of the day, it has to be the strong GDP numbers that Reema was just referring to. 8.2% kind of a growth in the second quarter. That takes the first year's average now to 8%, making sure that for the full year, we're probably set to cross about 7% or so of the rates, and how that makes RBI's job difficult. That and a whole lot to address. So we'll bring in our guests. Aditi Nair, the chief economist at ICRA, is joining in. Also with her, we have another economist. We have Madan Sabnavis, chief economist at Bank of Baroda, with us. Aditi, Madan, both of you, thank you so much for your time. Aditi, first, this differential between the nominal and the real GDP, thanks to that 0.5% deflator that people have been talking a lot about over the weekend. It's come down, I think, from a wide difference from 2023 to now where it is currently. What was some of your additional reading on this? I mean, is that still somewhat of a negative, the fact that nominal GDP is still at 8.7%?
Thank you so much. Well, the fact is that with inflation levels being so low, both for the CPI and for the WPI, there was no option but for the deflator to be as narrow as this, and I think this trend is going to continue in the current quarter as well. In fact, the deflator may be even lower in the current quarter than what it was in Q2. After that, as the inflation prints normalize, particularly for the CPI, we should go back to relatively normal looking deflators in Q4 and in Q1. So because of the deflator being low, as the real GDP growth number, we're expecting it to show some amount of base effect-led moderation in the second half of the year from the 8% real GDP growth that we've seen in the first half of the year. So, we will possibly be looking at real GDP growth coming off in Q3, nominal GDP growth being very, just slightly higher than that. And then in Q4, at least the deflator being a bit higher, which would take the nominal GDP growth up in Q4 as compared to Q3.
Aditi, what is your sense of for FY26 for the full year? We've already crossed 8% now with the first half. What would that number look like?
So we're looking at 7.4% now. Definitely, we got a very high and an unexpectedly high growth in Q2 and also in Q1, which was on a lower base. But if we look at the kind of quarterly trends that we had in FY25, we saw the real GDP growth going up very sharply in Q3 and in Q4. So that is possibly something that's going to be a negative. A couple of other headwinds that we're looking at. We really don't know how finally the export situation will pan out given the tariffs related to the US, both for goods and for services. Is there going to be more pain ahead? In any case, a lot of upfronting has happened for exports. So, possibly whatever good news there was is in the past, and the second half of the year may not look very good in terms of exports to the US. And also specifically when we look at the government fiscal data, for the Government of India, the headroom which is left now for capital expenditure as compared to its budget for this year implies a 15% contraction in the second half of the year. We're hoping that there will be some sort of reallocation or an increase in allocation towards capex in the second half of the year so that this doesn't really turn into a headwind. But these are the things that we'll be watching out for. As of now, our full year real GDP growth forecast is now 7.4% after the higher than expected growth that we got for Q2.
Okay, just want to get both your opinion on what we should expect from the RBI this Friday. Does this Q2 GDP stunner push forward expectations of a rate cut, alter that? Aditi, you go first and then Madan come in.
So we thought that before getting the real, the GDP data on Friday, we thought that the balance was slightly tilted towards a final cut. But I think now after looking at an 8% average growth for H1, possibly we're in for a pause on Friday.
Okay, Madan?
In fact, we believe that the rate cut cycle is over even before the GDP growth numbers came in. The reason is that whenever you're talking of a rate cut, the question to ask is what exactly are we trying to achieve? Are we trying to bring about growth? I think that definitely is not the case because we're talking of India's GDP growth rate being in the region of close to 7.5% per year. Inflation, we all know, is something which has been down primarily on account of the base effect as well as food prices coming down. Now, this is something which will get reversed as we go towards the end of the year. And by the time we go into the next financial year, we are actually talking of inflation in the region of around 4 to 4.5%. So going on the basis of the real repo rate, which I think is going to be the final kind of a target, it may not be overtly stated, but that is something which is going to play around. I think 1.5% is the kind of real repo rate which we're looking at. And at 5.5%, I think we seem to be well priced. So therefore, end of the cycle, we remain at 5.5% for the year.
But Madan, call it me being the devil's advocate here or greedy for more. For the acceleration, we heard a lot of experts saying that for an acceleration to push towards the $5 trillion economy target, you need to grow at 9.5-10% on a sustainable basis. But if you would believe that an 8% growth would halt the rate cutting cycle, would another 25 not accelerate that push? Or do you believe that there are enough headwinds in place for the second half for the RBI to stay on cautious mode right now and then use that gunpowder when the need arises genuinely?
See, there are two things here. One is that we should remember that companies do not borrow money merely because it's cheap. So we saw during the pandemic where the repo rate was 4%, companies did not borrow just because money was coming cheap. So the important thing is to look at how demand is evolving. So as of today, there are signs that demand has taken off, especially in the consumer goods space. And there is reason to believe that capacity utilization rates could be improving here. And therefore, there could be some incentive to invest. And even in the past, we have seen that interest rates have really been the limiting factor for investment. When you see buoyant demand, you will tend to invest and possibly pass on the higher cost of interest costs to the consumer. But when we are talking of excess capacity, demand just about picking up, that's what we're expecting in Q3 on account of the GST 2.0 reforms. I think there is still a lot of space for investment to take place, notwithstanding the fact that the repo rate could be at 5.5%. Because finally, at the end of the day, RBI will also have to balance what happens to savings, which I think was mentioned in the discussion of the minutes, which was released for the last policy.
Madad, quick word on what your number for FY26 is. We've seen a spate of upgrades after the Q2 numbers came in, median pointing to around 7.4, 7.5% kind of a number, whereas RBI is still at 6.8. What sort of a revision do you expect there, and what is your own number?
Yeah, our number is 7.4 to 7.6. This is the number which we had when the GDP for second quarter was out. I would tend to believe that RBI would also probably revise it in upward direction. It would be in the 7% range. They normally tend to be a bit conservative, so I don't expect them to go to 7.5. It will probably be 7.2, 7.3%. Okay,
so not a steep up move there from RBI, but a 7.2, 7.3% kind of a upgrade. But Madan, quickly, your comments also as well on what I was asking Madhvi, essentially this 0.5% GDP deflator. Are you worried that would be exaggerating the real growth numbers that we're seeing? Because in the second half, without the base effect, without this, export up move, what sort of a number are we likely to see?
So actually, if you look at the way in which GDP is calculated, you get the value of commodities, which is always only at current prices. So when we're talking of real GDP, where we want to remove the price effect, that's when the deflator really comes in. So I don't see anything inappropriate or anything which is untoward when we're looking at 8.7 and 8.2%. I mean, that is what is bound to play out when we're talking in terms of reducing anything at current prices into real terms. And since our inflation numbers have tended to be negative for WPI, very low for CPI, it's but natural that this number comes down. Now, is it going to create a problem, except maybe an academic discussion as to we are used to maybe around 2.5 to 4% difference between the two growth rates. Now it's going to be very much narrow. I think the issues will actually come up when you're looking at other kind of ratios. You're looking at the fiscal deficit. You're looking at the current account deficit. Those are the numbers which would tend to be under pressure on account of the denominator not growing at a very high rate. But the difference between the two, I think, is something which is perfectly all right. I don't see anything wrong in the methodology or in the approach taken by the CSO when they are computing these numbers. It's but natural because we've had very unusual inflation numbers, which all of us know is more because of statistical reasons. Because if you go to the market today, I think none of us can really believe that vegetable prices have actually fallen. They've actually gone up. But the CPI is going to continue to show that vegetable inflation is in the negative region. So I think these are the kind of anomalies which are there, but I don't think there is anything to get worried about.
All right. We're done with the first half of the year with an 8% average. We'll see what the rest of the year looks like. Aditi, Madad, both of you, thanks very much for joining in here. I guess, Hormaz and Rima, the real question really is on Friday. Yeah. How can RBI justify that rate cut when the economy is firing at 8% kind of growth rates? I think it's going to make RBI's job real hard.
Real hard, no doubt about that. We will slip into a short break. On the other side, we'll discuss crypto markets with Manisha Gupta on the other side. Stay tuned.
Welcome back. Shifting focus to the crypto markets now. Manisha is here. And Manisha, it's a new month, but it's the same old SOP sell-off story.
It is. And, while we haven't just seen sell-off that's come in Bitcoins and altcoins and all those platform one exchanges, but it also is about meme coins. And that's what I'm talking about today. Well, we are trading at the lowest level in sense of market cap for meme caps into 2025 there. If you look at the daily trading volumes on the decentralized exchanges, well, that's declined 70% on a year-on-year basis. So that's exactly what is happening here. This has been an interesting year, by the way, because as we saw institutional, retail and corporate adoption coming in, they went in for blue chips and not so much for meme coins. And that was another reason that you saw prices decline. So blue chip cryptos did quite well. And one of this money, a lot of reports say, has moved into AI projects as well. So no takers really when it comes to meme coins in this year, especially. What are meme coins? Well, these are cryptocurrencies that are inspired by internet memes, pop culture, viral social media trends. Also interestingly, well, meme coins generally lack any substantial utility case or real-world assets, etc. And that is the reason you only see people enjoying that. No serious investors is what you would perhaps see when it comes to meme coins there. Primarily, it is community-driven, and that is what makes it very, very highly speculative. And the prices are driven by hype and speculation. That's another reason that we have seen a very sharp decline at a time, especially when you have almost everything else declining as well in sense of within the asset class there. Take a look at the prices there. And, you know, the last 2 or 3 years, we've seen Dogecoin do quite well. But that one is down 56% in this week, or this year rather. Pepe is down 79%, Fatcoin is down 80%, and these are, by the way, by order of market cap in the international markets there. Shiba Inu is something that a lot of Indians also bought, but that one is also down by 62% when it comes to this year. And Peanut is down 88%, but not everything in meme coin is down as well. You have a coin called Useless, which is up by 19% in this year. And you have Giggle up to 22%, and the Trump coin is up to 49%. So there are still some buyers when you can see that in space.
Loving the names, Manisha. How do you say this with a straight voice?
We were surely giggling when we heard of Useless being up 19%. That's possibly the highlight of this. Manisha, thank you for that update there. Take a short break, get back on the markets and get more on the chart checks going and some top trading bets as well. The Nifty currently 40 points lower on the other side. Stay tuned. We'll be right back.
Welcome back. You're watching Trading Hour. Markets in the green. We'll pull up the charts for you very quickly. Sensex at 85,865, up 155 points as we speak. And the Nifty, of course, at 26,247. Still a little away from 26,300, the mark that the markets are watching out for. But Manish Hathiramani from Deen Dayal Investments joins us for a quick technical check of the market. Manish, welcome to the show. Thanks for your time here. You know, how are you trading the markets now and your top stock picks for the day?
Good morning to you and to all our viewers. Well, I've been of the opinion that 26,450 to 26,500 is a potential target for this current rally. However, the markets have been a little nervous. The first proof of that had come on Friday, when we were a little nervous during the day. Today, we've resumed the uptrend. If you notice, the first half of the day seemed to be all bullish. We are again getting nervous a little right now. But we really need to evaluate the Nifty direction once we have achieved that level of 26,500. Considering that I continue being bullish, I am working with 2 buy calls today. The first one is on Bharti Airtel, which is for a target of 2190, stop loss of 2090. This stock had opened with a gap down on 26th of November, but we failed to follow through on the downside, which is actually a positive sign. Thereafter, we've seen trickles of healthy volumes with an inclining price. Therefore, with a favorable risk is to reward ratio, this trade can be endeavored. The second one is on M&M, which is for a target of 3830, stop loss of 3740. This stock has been sideways, where 3780 was the upper end of the trading band. We have crossed that today, and we can expect an upside momentum.
You know, Manish, there has been a lot of concern with regards to the market breadth when it comes to the broader markets. Both of your picks were Nifty names. But are there any broader market names that look good to you, or do you believe that this broader market trend of adverse market breadth is likely to continue even more, even though the mid-cap index is closer to record high levels?
Well, actually, mid-cap is one of the resilient indices that I'm working with. I still feel that this 6925, which was the high of 23rd September, has been crossed, which opens a new medium-term target of 63,000. And we have a good support at 60,500. So coming to your question, I still feel that it will be an outperformance, which is going to be purely stock-based.
Thank you, Manish, for joining in. Let's talk about Lenskart. That's in focus after the company released its first quarterly earnings print post the IPO. Numbers are looking good. Growth is up. Stock is holding up in the green. Vinny joins in with the details. Vinny?
Hi Reema, good morning. So yes, in terms of Lenskart stock, managing to still hold on to gains though of the day's highest point as of now. But yes, first quarterly numbers post its listing that's come in Q2 FY26 numbers, good numbers, 21% growth in terms of revenues. EBITDA margins have seen more than 300 basis point expansion. 19.8% is what the EBITDA margins came in versus the 16.5%. Even the profits of the company have seen a growth of 20%. But yes, the profits of the company this time were impacted by higher depreciation costs that impacted the overall number in terms of the profitability of the company. Nonetheless, 20% growth there. When you look at it in terms of the segments of what has done well, international business, that's seeing a very good growth for the company as well. 34% growth on a year-on-year basis. Margins in the international business, EBIT margins, that is at around 3.5%. Last time it was an EBIT loss, so there was nothing there. So yes, now it's an EBIT margin positive on the international business front. India business also has done well, 13% growth there. EBIT has seen a growth of 30.7%, and obviously a 10.2% EBIT margin for the India business. The H1 same-store sales growth also came in at 15.3%. India same-store level EBITDA margins were at around 33%. So good performance there, good growth there, and outlook for FY26 is also positive, and that is why the stock is holding on to those gains today.
Thank you very much for that. You can see some lines about an excise duty hike on tobacco products. This is what our colleague Tim C has picked up. So what the government has proposed is a capacity-based cess exclusively on pan masala. And the excise duty hike on tobacco products will include cigarettes, cigars, chewing tobacco like gutka. Under the proposal, the excise on cigarettes would range from 2,700 rupees per 1,000 sticks to 11,000 rupees per 1,000 sticks, depending on the size and category. And one key distinction will be how the revenue is going to be shared. So excise collections will go into the divisible pool, which means the states will receive their mandated share as per the formula which is there. But the health and national security cess collections do not go to the states. These proceeds will remain with the centre. So we'll try and get Tim C more on that. The stocks like Godfrey Phillips reacting. ITC has been on the flatter side, but with a bit of a negative bias. Do we have Tim C with us? Okay, we'll try and connect with her, but that's the important story that we are tracking for now. The other stock which you should have on your radar is Tejas Networks. Now, this stock is on our radar because the company received a PLI worth about 85 crore from the Department of Telecommunication. This refers to the 85% of the eligible PLI incentive for Q4. The balance amount is expected to be released consequently. And the company has been every quarter getting some PLI amount or no. In prior quarter, it did, but the quarter before that, it was about 122. In Q4, it also received some PLI incentives. But year to date, the stock has been under massive pressure, 55%. And the key reason is BSNL's 4G rollout caused a sharp decline in the company's revenues. So Q1 sales fell 87%, Q2 revenues were down 90%. Because of this sharp decline in revenue, on account of BSNL's 4G rollout delay, the company reported losses for 3 consecutive quarters, and even the receivable situation ballooned. And that's the reason why even the borrowing amount of the company went up quite drastically. So it's okay today, up 2.5%, but year to date, you are seeing a fall of 55% on the stock.
The worst performing stock on the small cap index on a year-to-date basis is Tejas Networks. And of course, we'll keep touching base with this excise proposals on from the Parliament as well. Based on what Timsy has sent, the excise on cigarettes to vary from 2,700 rupees per 1,000 sticks to around 11,000 rupees a 1,000 sticks. The reaction in ITC has not been very significant. It has recovered from the lows of the day. Of course, that is because the stock itself, the company itself, is diversified into many other businesses apart from cigarettes, be it hotels or be it FMCG and so on. But can't say the same for Godfrey Phillips as well, because that is the one that predominantly relies on cigarettes for its top line. We'll keep touching base on this subject through the course of the day. Take a short break, take this conversation and a lot on the markets as well forward with Nikunj Doshi from Bay Capital, who joins in on the other side. Welcome back. There is some buying interest emerging from the lower levels for the markets, at least. The Nifty is at least 20 to 30 points off the lows of the day, back at 26,260. And Nikunj Doshi from Bay Capital joins in now to talk markets and a lot more. Nikunj, good morning. Thank you for joining in. I'd like to talk not specifically to those stocks, but the new listings that have come out recently, be it Lenskart, be it Grow, be it PhysicsWallah. The basic conversation around all of them have been how they have been valued. For a lot of them, at least for Grow, it's profitable. But for a lot of the other companies that are coming out or have come out, they are still loss-making. They have just recently turned profitable. Do they justify the kind of valuations that they are commanding? And how forward do you extrapolate that multiple, hoping that they would eventually turn profitable 3-4 years down the line?
See, again, valuation for digital first companies, I would say is a lot depends on the expectation of growth. So even though if they are making losses, but the initial cost of client acquisition is very high for these companies. And that's where they incur cost in acquiring clients, and that actually creates losses in the beginning of the businesses. But as and when the number of clients improves, there's a huge operating leverage which plays out in all these digital first companies. And I think that's what people are factoring in when they project for, say, next 3 to 5 years. And you look at 3 to 5 years roadmap at least for these companies. And when the hyperbolic profitability growth kicks in, that is the time you expect the values to go to PE multiple levels rather than the story level. So at present, it's more of a story and less of a price earning multiple. But going forward, after 3 to 5 years, people start looking at PE, and that's where the valuation is benchmarked today.
All right, Nikunj, the big macro, data after the GDP that the markets will be taking cues from is what happens on Friday, with the RBI policy. How are you going to play the markets ahead of that, and what are your expectations?
See, I think if we look at inflation, which is a key monitorable for the RBI, it's under control. GDP growth, if you look at real GDP growth, that's good. But nominal GDP growth, I would say, because of the deflationary factor, is still, I would say, lower than expected. So I think RBI will go ahead with rate cut in this policy. And perhaps that will help growth going forward. And government, if we look at all the decisions that the government is taking, they are focusing on the growth of the economy and of the corporates because they want to encourage private capex happening in the economy. So I think we expect at least a quarter basis point rate cut in this RBI policy. And that would be positive for the market.
By the way, the rupee has hit a fresh record of 89.59 against the dollar now. This has been the year where India's underperformance versus the global markets, the range of underperformance is the widest that we've seen in more than a decade. It's also the year in which the rupee has been the worst performing currency in the Asian market. And now you are seeing, and it's a very sharp fall coming through. Just in the last 10 minutes or so, it's 89.59 on the rupee against the dollar. Nikunj, you want to come in on the currency and its performance this year, and how does it shape the way one should construct our portfolio?
See, I think currency, if we look at it, if you look at the relative basis of the basket of currencies, then I think Indian rupee had been doing very well in the past, and it was holding on very well. But I think after the US tariff, I think the RBI has decided to make it slightly looser policy on the forex rate. And I think this, I would say, devaluation of rupee, I would say it's more of a desired kind of outcome rather than the unintended. So I think it's intended outfall. Because to help the domestic economy to look at the exports. So I would say rupee, if stays around 88 to 90 band, it is still good for the economy.
Surprising, right, Ritu? Considering that we got the strong Q2 GDP print,
yeah,
you would have thought that would provide some strength to the Indian currency, but that's not the way it's played out.
No, not at all. And in fact, we need to see, what's behind that kind of a slip that we're seeing now. Nikunj, finally, just also to get a sense of what triggers positive or negative, you expect will play out for the remainder of the fiscal by FY26? With what we've heard on the trade deal front as well, how that, of course, will impact the broader macros.
See, if you look at the recent announcement of the labor code, I think that A, reduces income in the hands of the wage earners, and B, for corporates, the cost of labor will go up. In a slightly smaller manner, but that may reduce the consumption in the immediate future. But if you look at the longer term, say 6 to 9 months kind of a view, I think it will rebound. Secondly, there's a pay commission announcement expected that will again provide a huge trigger. Then the other thing is that come CY26, we see earning upgrade cycle happening for the Indian corporates. So I think that will also provide a lot of comfort to the foreign investors, because till date we were seeing earning downgrades. Now, when the earning upgrade cycle starts happening, then the foreigners also will be keen to invest. Rupee also is at a level where perhaps foreigner will be more comfortable taking a call on INR dollar. So I think overall we are expecting CY26 to be a huge positive for the Indian equities. And I think it will start from, say, February, January itself. I mean, the result season of December.
The bulls would certainly be hoping so. But Nikunj, thank you for sparing time and joining us. By the way, the fall on the rupee now continues. 89.67 is where the record low of the rupee now stands against the US dollar. It's depreciated almost 90 paisa since the very recent against the US dollar. So the weakness in the rupee continues. We had seen a very similar move last week as well, and the rupee fell past a very critical level that the RBI had been defending for a very long time, and then we saw that one-way move towards the 89.50 mark, and after a few days of hovering around that 89.45, 89.50 mark, today we've seen yet another one-way move on the downside when it compares to the currency. A 90 paisa depreciation against the dollar since the 3rd of November. So it's almost a rupee. The currency has depreciated in almost a month now. So 89.67, the new low for the currency. And we'll get more comments on this. And this is coming right after the GDP print and right before the RBI policy. So there are, of course, a couple of other important things that need to be tracked when it comes to the currency. But the markets as of now, they have also come off the highs of the day, and so 26,250 is where the index currently stands. But Ritu, the rupee now continues to remain the key monitorable. It does look like the RBI is not willing to defend some very important levels.
Well, yes, last time we'd seen RBI move away from the markets for a little while when you saw the currency slip there. But, this is a 90 paise downfall. That's a steep fall that we're seeing on the rupee. And we have Mithul Kotecha, who's the head of Forex at Barclays, joining in. Mithul, quick reading, rupee at 89.66 to the dollar. What's gone wrong there?
Well, it looks like RBI are not at the moment
providing
defending
support.
These levels. We thought, obviously, there would be, or a lot of investors were looking at sort of 89.50 as a sort of a new level of resistance for dollar rupee. It hasn't been the case. Again, we would be surprised if they allow this fall to in the rupee to get out of hand and for it to slide dramatically. And I think a lot of people will now be looking at 90 as a new sort of level or new line in the sand. But clearly, this move it's taken place at a time where we've just had some very decent GDP numbers in India, which should have been more positive for the currency. Capital flows or portfolio flows have been also less negative recently, and yet we're still seeing this inherent dollar demand coming through here. So it does look like RBI allowing a little bit more weakness in the currency here, but we would be surprised if they don't step in at some point soon.
But you're saying 90 is coming, Mithul? I know we're not very far away from it, just about 34 paise. But that would be the level to track. And what happens if we do get progress on the India-US trade deal?
Well, I think, look, 90 is psychologically a very important level. We've been highlighting that it's a matter of time before we break 90, although we probably wouldn't have expected it to happen so soon. But again, I think if there is a trade deal announcement, it would probably see a knee-jerk rally in the rupee. And again, at the moment, there's been a lot of anticipation, continued comments from both the US and Indian officials that a trade deal is close at hand, and yet we still haven't got anything in hand. So at this moment in time, that could be a saving grace for the rupee at this, if we do see an announcement. But the question is how long any rupee rally would persist for. We think probably would be a short-term knee-jerk rally in the currency, but it would provide some relief.
But, any further narrowing of the interest rate differential, given, the RBI set to announce its policy this Friday, do you think that could put further pressure on the rupee?
Well, depending on what the RBI do, I mean, if they cut rates, then it could add a little bit more pressure. But ultimately, we think now that certainly after the strong GDP print, it seems unlikely that the RBI will cut rates at this week's meeting and probably save their ammunition as needed, even though inflation remains very, very low. There's no urgency here to ease policy. If anything, the RBI may want to inject liquidity and try and use alternative methods to try and keep liquidity ample in the system. But I think for a rate cut, yes, if they cut and it's dovish, markets would probably perceive that as more negative for the currency.
89.76 now is where the currency is. So further depreciation from the 89.67 levels that we just spoke about, Mitul. And you are mentioning that 90 is now a very important psychological level. What is the street possibly trying to price in when you see such kind of depreciations? Because such kind of moves you don't get to see very often. We saw and we've seen two such moves in a matter of a week.
That's right. Look, I think there's just inherent dollar demand. I think the reality is that importers have probably been holding back from buying dollars in recent weeks, and we may be seeing some of that coming through. At the same time, as forwards roll off, you also see some inherent buying of dollars. So it's probably a combination of factors. I'm not necessarily sure that this is suddenly the market turning particularly bearish on India's fundamentals or the rupee itself. After all, the currency is extremely cheap on a valuation basis, so it's not as if there's a huge amount of benefit here from weakening the currency even further. And it's also not as if India is suffering from any sort of balance of payments issues. This is not the case. So again, I don't believe necessarily that this is a fundamentally led weakening of the currency, but it is a case where the inherent dollar demand on any dip or these sort of levels continues to come through, especially against a backdrop where the US dollar itself has been firm in recent weeks.
The 27 paise now, Mitul, that's a very steep decline seen in the Indian currency. You're saying there is absolutely no trigger day on day over the last 24 hours, which explains this fall?
Well, fundamentally, it's hard to see anything. You could argue the other thing. If there's been the fundamental news has been positive, the GDP print was strong, and if anything, that may have also dampened expectations of a rate cut. So when you talk about rate differentials, it should bode well for the rupee. So it's hard, and certainly we've not seen anything here that would trigger this from a fundamental perspective.
Let me get in Lata as well into the conversation. Lata, you want to first comment on what we're seeing right now in the currency market?
I can tell you what I'm picking up from Forex dealing rooms. Mitul, of course, has given you a version. As Mitul said, it's not anything special that's happening today, but on a daily basis, irrespective of what the macros are, the flows, the outflows of dollar are more than the inflows. I mean, it's no secret that we are seeing continually almost 4,000 crores of sales over the last 2 days. We saw a dip last week in the portfolio sales, but it picked up again by the end of the week. And therefore, there is that demand to buy dollars by people who are moving out. The Reserve Bank is the only supplier in the market sometimes because exporters still believe they can get a better deal. So much depends on what the Reserve Bank is thinking. So the dealers are now trying to outthink the RBI, basically. The explanation I got from dealers is the Reserve Bank has decided to let go in a gradual manner. And, allow the market forces to take over. They're probably also telling the market that maybe a cheaper rupee is the solution to this gradual, continual, persistent attack on the rupee. At a point, the rupee becomes attractive and stocks become attractive. So the Reserve Bank's point could also be by indicating it is comfortable with a gradually falling rupee that, the current account deficit gets resolved. Imports will become expensive if you're going to multiply every dollar with 90 instead of 85. Imports will fall and there will be a gradual and natural correction to the current account deficit, which obviously went up very sharply in October. So it could be, applying the balm. This is their way of applying it and doing it in a gradual manner. The other interpretation I picked up, and Mithul alluded to the rate differential, now the expectation will be that RBI won't cut and therefore actually, that should be pro-rupee if RBI won't cut. Yeah. But the market is veering around to that view probably, and that is why there is more FPI sales. Equity guys want the cut. So maybe that is also leading to an increased selling. But all this is guesswork. All we know is that there are foreign portfolio investors buying out dollars. There will be traders who will front run them as well. And the only supplier or the only material supplier of dollars in the market is the Reserve Bank. And so the dollar rupee exchange rate is where the RBI wants it to be.
Okay, so RBI letting the rupee gradually weaken, and now it appears to have stabilized around that 89.73 mark. Mithul, thank you very much for joining in with your perspective. The very sharp fall in the currency has also dragged the markets into the red. The Nifty is now below 26,200, given up all the morning gains. Remember, we hit a record high in the morning on the Nifty at 26,325, and now we've slipped close to about 150 points from the top. Get into a break. We'll come back with more. Welcome back. Let's turn our attention now to the agri, chemicals and fertilizer space. Ranjit Sirumala, Vice President Research at IIFL, tracking the sector very closely, is now joining in. Ranjit, before we get chatting about the outlook for second half for the agri sector, let's quickly recap Q2. You've titled your Q2 review note as Headwinds at Home, Tailwinds Abroad. Basically, domestic has been subdued while exports have held up well, and that is the defining theme of Q2. Can you quickly recap how the individual sub-segments have fared and what the trends were?
Right, thank you. So if you look at the start of the year, we were expecting gradual recovery to pan out. But as the year progresses, we all are aware that what transpired during the year, the primary would have been the tariffs that were never anticipated. We started off with 15%, inched up to 20%, and there are 50% tariffs that we are seeing on the exports front. On the domestic fronts, the monsoons were a bit early this year. At least in the month of May is what we have seen. And this year what we had is almost 6 months of rains. So 1Q, we have seen a very strong pickup in the agrochemicals sales. But as we headed into September, the excessive rains did impact the consumption. And that's where we saw 2Q results waning off. While on the export front, if you see, there were pockets of outperformance. Refrigerant pack, all the companies that have an exposure to refrigerants have done very well. But at the same time, what we also see, the worst of destocking cycle is very well behind us. Most of the global agrochemical companies have started delivering the volume growth, and that is where we see the companies did benefit from that volume growth. As regards to pricing, we still see that it is continue to remain in a negative zone, and that is what would be the key trigger to watch out for. Though we have seen a bit of an uptick over the last couple of weeks, or a month or so, some agrochemicals prices did inch up. But at the aggregate level, we still see that in a negative zone.
Sorry to cut you in, Ranjit. So based on what you said, does the second half, do you anticipate a rebound for these agrochemical companies? And if they do, would that be enough to offset the subdued performance in the first half?
See that if you split that into two parts, the domestic Kharif is almost 65-70% of the consumption, and that is being done with. So Rabi, even though we do expect, but that won't be suffice to kind of take care of the full year. And this is for the domestic agrochemical companies. We will have to look forward to the next year, the cropping season. As far as the exports are concerned, second half is very heavy. We do see a strong pickup in the LATAM and the North American markets. And that is where the key would be. The companies that have an exposure to the North American and LATAM markets, the second half should be much better than the first half.
The real impact on stocks on account of the US tariffs?
There are quite a few. As I said, some companies were able to mitigate that and have taken a bit of a hit on the profitability. But there are also companies which have kind of a rerouting their exports. So all we know that Aarti has an higher exposure to the US markets, but their energy segments did very well in 2Q, and that's why they were able to set off that particular thing. What we also see that the dumping into India is also kind of a picked up. So all these geopolitical tensions and tariffs have kind of an altered the global trade flows. What we see is that there is a dumping happening from China into Brazil, dumping happening from the Chinese goods into India. And the companies that are competing with these goods will see their profitability coming under pressure. Nevertheless, what we also see, the outsourcing theme is intact. The companies that are able to kind of get a newer molecules, are able to push through or able to win new contracts have done very well and are expected to do well.
All right, Ranjit, we'll leave it at that. Thank you very much for joining in here. On that note, we're also going to wrap up this edition of Trading Hour. Thanks very much for tuning in. Stay with us. Halftime Report will take all the action forward.